We're already talking about it. That's how hot this topic is. CardinalStone, welcome back to the show, by the way. Global Business Report here on Arise News. Have a new mid-year outlook for 2026 on the Nigerian economy. And the report, of course, touches on a lot. There it is. I like the analogy with the ship. Steady hands on shifting grounds, which would probably suggest that the climate and the seas might get pretty volatile, right? And the ship has to stay steady. So Olaolu Boboye joins us, lead economist, fixed income strategist over at CardinalStone to discuss. And we've had Olaolu on the show before in the initial report. Now we have mid-year. Good to have you back on the show. Good morning. Thanks for joining us.
Yeah.
Look, I actually went through some of this report yesterday, and I want to start with productivity and labor outputs. You've got a chart where you show that $1.94 is, yeah. So why in the end you compared it to the African peers? Why is our productivity so low, Olaolu?
Okay, so part of the reason why Nigeria's productivity is low is, first, if you consider the productivity from a dollar term, you'll notice that FX has badly beaten down the productivity, right? Because if you look at it from a Naira term, it's maintaining an upward trajectory. But beyond the Naira conversation, FX conversation in the labor productivity, we categorize the major factors influencing that productivity into three things. Number one, we try to look at the educational system in the Nigeria sector, in the Nigerian economy. Secondly, we look at the informal economy. And then third, we look at what we refer to as a jobless growth market. On the first, which is the educational narrative, one of the things we notice is at the moment we have out-of-school children of about 10 million, which is one of the highest in Africa and one of the highest in emerging markets. Secondly, we looked at currently the total number of Nigeria's population, right, that don't have education at all. About 27% of them don't have education.
Huge number.
It's huge. And when you compare us to a country like China, right, I'm interested in China or even other African countries, they have a better educational system. Then when you also look at the curriculum of the Nigerian educational system, we need to revamp that curriculum, right? We need to make it more STEM-driven, right? Science, technology, engineering, and the likes. Then from the size of the informal markets, about 50% of the Nigerian economy is informal, right? In that informal, it has been said that the level of productivity in the informal sector is 2 times lower than that of the formal sector. So practically, they are dragging down things. And that space employs more than 97% of Nigerians. Wow. So clearly, there is need for improvement there. Yeah. And then the last is the jobless growth, where we have the fastest growing sector reporting the lowest number of growth numbers. So clearly, that's also creating a bit of issue for Nigeria.
Your chart compares the comparison between Nigeria and there it is, to the other countries. It is, it's so low that it is below the purple line, which is your sub-Saharan Africa low income line. So, any chance of catching up?
Yes, so we can catch up, right? There is need for clarity, and there is need for it's going to be systematic. It's not something you can do in 1 year. Based on our estimates, if we are aggressive, right? Aggressive, when I mean aggressive, you look at countries like Vietnam, countries like China, who are quite aggressive. If you can follow their footsteps, in 15 years to 20 years, Nigeria can close this gap material and be one of the fastest growing labor productivity narrative in Africa, right? But we need to be aggressive about it, and it will take time. It's not something that can happen in 2 years or even 5 years. A minimum of 15 to 20 years.
Wow. Funny you mentioned Vietnam. We had a report on Vietnam's, the rise of Vietnam earlier this week. So on the education side, you mentioned it, and you even have a chart on the makeup of workforce education. So you've already laid out the issues there, and you've given the numbers, that 27% figure. So Is this a money issue? You talk about revamping the curriculum and so on and so forth. How do we boost our workforce education? And look, our private schools are pretty good here, right? So I guess it's a public school issue. But so what do we do?
Most of the people going to school, they are largely skewed towards government schools. That's this aspect, or that's the kind of school that is affordable. Private schools are solid. If you look at some of the private universities that we have, they are ranked within the top 600, 700 globally, which means that they're solid. We have a business school in Nigeria, which is the best in Africa, clearly. So the privates are solid, but the government also needs to do more investment. We need more collaboration with the private sector, more PPP funding. So if you look at most of the government PPP funding today, you're talking about the gas space, space, you're talking about the oil and gas space. We need huge investment in the educational space also. We need retraining of teachers. It's a whole lot of work that needs to be done.
Holistic.
And, exactly. That's just the word, holistic.
Okay, since we're talking money, let's get to oil. You lovely chart where you've got oil production, and then you've also got what that means for the income of the country. So net oil revenues in the purplish line, and then the bars with oil production. Look, while the same, I guess, for a nation of 200 million people, Qatar that hosted the last World Cup, I think they're about 34 million. They're doing 2 million barrels. Well, what's your takeaway from where we are with oil revenues from oil?
When we did this chart, what we had in mind was to look at three things. One, we tried to disintegrate Nigeria's oil revenue into three: production, price, and FX. We're trying to estimate what will be the windfall gain from these well elevated oil prices, because we might be having excess crude oil accounts like we had some 10 years ago. When we did our analysis, we discovered that the biggest influence on oil revenue is production. FX will give you a coefficient of about 1.2 times, 1.2. Price will give you about 0.9. The biggest, which is about 2.3, is production. We need to boost production. Currently, production is around 1.7 million barrels. It just recently improved to 1.7. For most of the months in the year, it's been hovering around 1.5, 1.6 plus condensate. So clearly, we need to boost oil production. If oil production had gotten to government target of 1.84 million barrels per day, we would have seen a net savings or a net windfall from oil revenue of about 2 trillion within the space of March to May. But we saw somewhere around maybe 250, 260 thereabout, because production was weak. So production will feed into your oil and gas GDP to feed into your government revenue. So clearly, we need to do more to improve it.
What about non-oil? And look, you have a chart on non-oil revenues, and it looks, you've got 2023, 2025, higher non-oil revenues. What's the makeup here? Is it mostly taxes or exporting sesame seeds or what have you? And Olaolu, I think the main thing is FX, right? You just broke down those three categories for oil. What is the picture with non-oil? Okay,
so there are two sides to view non-oil. There are non-oil that are not FX, right? Local taxes, they are not FX, except for maybe oil and gas related taxes, but majorly some of it are not FX related. For the non-FX related parts, what we've been seeing is that there's an improvement. In fact, in the first 5 months of this year, we saw that the government made a gross net oil revenue of about 15 trillion, which is one of the highest historically, and that's largely driven by local taxes. Then if you now go to the second leg of saying, okay, what is our non-oil revenue, right? In terms of what we're exporting, that's non-oil exports. What you see is that we've seen a change from where we used to see oil being the dominant factor. We are now having sub-segment of oil. It's still oil, but we are now having sub-segments. We have seen gas and refined products. Cumulatively, annualized, these two will give you somewhere around 20 to 21 billion dollars annually, which is a material improvement from less than 10 billion that we used to see a year ago. Then when you now come to non-oil that has no relation to oil at all, that's giving you somewhere around $10 billion per year. It has improved a bit, but it can do more. So we need to boost that material. But I think the government focus for now is on gas, and the private activities in the refining space is boosting export of refined products.
Time said this time around the Dangote refinery has you just mentioned refined products, so that's of course has a role to play there. Right? Okay. To the states, and we talked about this on your last report, because you really glad that you guys focused on the states, because we had it, Arise News hosted this town hall in Abuja at the This Day Dome on states police. We know where that's going now, and everybody kept talking about funding. Governor of Enugu was there, Governor of Zamfara, Governor of Anambra. So you pointed this out last time. So FAC allocations, and you can see the material increase from 2021 to 2022, and then 2023 to the monthly average. That's up. But I did want to ask you about the capex as a percentage of GDP for the states, and it's going up as well. But is that enough in terms of where that's going? That's the next chart that we have. But is that enough?
So it's not enough, right? But it's an improvement, right? for 2 years ago, we used to be less than a percentage, but now, as of last year, and then it's around 2.5%, 2.3% thereabout. That's a material improvement, right? But you pointed out state policing, which for me, I think is interesting. I feel like state governments who are saying that they may not be able to accommodate that, they need to be able to factor that into their budget.
Right.
From our own initial analysis, a few number of them may be able to incorporate the cost of those state policing, right? So they are doing capex. If you look at the contribution, the breakdown of those capex, we are seeing it in the agri space, we are seeing it in industrial space. That's why you've seen a few number of states who now has airports. So people are now going into airports, going into activities. So it's a good one that they are pushing for that. But I strongly think that they need to add that state policing into the equation.
Into their budgets, yeah. Okay. All right, so there it is. That's the increase in capex percentage of GDP. But also on debt, and I'm going to get to Nigeria's debt as a whole, but I know you pointed this out before. So you've got the great chart, your purple bar chart showing the total debt, and then you've got your debt as a percentage of GDP coming down. So can your states are getting more money, FAC allocation is going up, you're increasing your capex percentage of GDP as a percentage, your debt as a percentage of your GDP is coming down. How will state citizens feel this in the respective states? So
one of the arguments that we've had in the past is that all the narrative that are going on in the country today are largely domiciled in the macro space.
Right.
It's yet to permeate into the micro space. And I once provided an argument that for any reform that governments do to permeate into the real sector, to permeate into the micro space, it typically takes a while, 5 years to 10 years, based on the comparable countries that we've looked at in the past. So at the moment, most of what government has done, most of the repayment that the state government are doing, not everything is getting down to the citizen.
Yeah.
Some are doing roads. People are appreciating the roads being done. We are seeing airports. We are seeing a bit of construction activities, but people want more. People want lower inflation. People want better income. If you look at real income in Nigeria today, it's practically one of the lowest in Africa, right? Some 2004, 2005, you can literally travel out of the country to Dubai with 200,000, 300,000. You can't do that now.
Right.
So the wallet is strained. They need more income, basically, and lower inflation to be able to live.
Now taking debt now to the wider the country itself, and we've had a full series yesterday looking at all our past guests talking about debt. I want to have you as part of that conversation. The World Bank said Nigeria is a moderately indebted nation. Others have said it's not as bad as the conversation is. So with your projection here through 2026, you've got the external and the domestic. What's your takeaway of where the nation is in terms of our debt? Because it's a pre-election year, so of course it's going to be part of the conversation. Where are you seeing debt?
One, our debt will touch about 185 to close to 190 trillion by the end of the year. That's a lot. Secondly, the risk of debt distress at the moment is moderate. So we don't see risks of debt distress based on all debt sustainability metrics. Nigeria is mostly fine on all those metrics. The only concern that IMF echoed, which we also agree with, is we need more clarity on our external debt. So if you are doing external debt, give us tier sheets. Let's look at the breakdown. It will give us leeway to be able to properly analyze them. So for some of the external debt, there's no clarity on them, basically. And then we now have off-balance sheet projects being done, even though it's approved, right? We need clarity on them just to be able to help us forecast debt numbers appropriate. But regardless, we think that Nigeria's debt is sustainable at current levels.
Okay. Finally, so in fact, I think this is a good way to summarize the entire conversation. You did revise downwards your GDP growth for 2026. So you're initially at 4.4, now you should down to 4.2. What's your reason for that?
So Q1, we noticed that the numbers that came out missed our estimates. Part of what influenced that was the leading indicators that we look at. So PMI and other high-powered data series that we saw, we noticed that there was a bit of struggle, which may have been linked to the global geopolitics factor that brought about a renewed inflationary pressure in the economy. And to a certain extent, inflation has impact on the overall economy. So that's dragged down Q1 numbers a bit, even up until May, but we started seeing recovery in June numbers. And so that influenced our thoughts to, downgrade the numbers slightly. But 4.2% is still solid.
Yeah, compared to prior, right.
So it's still one of the highest in the last 5 years.
Olaolu Boboye, lead economist, fixed income strategist, CardinalStone. Always a pleasure having you on. You guys, your reports are very in-depth, very informative. I encourage everyone to read them. Thank you so much for joining us.
Thank you for having me.